Alright, hi everybody. Today I want to discuss a topic that you might not expect. I want to talk about a stock bubble that no one is really talking about. And we're not talking about the typical high-flying tech names or the latest artificial intelligence frenzy. No, we are going to talk about a quiet bubble that is quietly forming around some of the best businesses in the world. The ones known for their resilience, solid fundamentals, and decent growth prospects. These are the companies everyone loves, investors love in particular, and whose products and services many are using on a daily basis. But despite all of these great quality attributes, I think investors need to ask themselves, are we at a point right now where we are overpaying for this quality? So today we're going to look at some of the names that I think fall into this quiet bubble category. We are going to look at the valuation of quote-unquote quality names, and we are going to discuss what I think with regard to the outlook of these stocks. So without further ado, let's get started. All right, so what I've prepared for this video are a couple of different charts that are going to focus on the quality side of things, that are going to focus on the valuation of some of the names that I'm going to present in this video, and the valuation of so-called quality indices, and how I would maneuver the current investing landscape. So let's start with a couple of stocks that I think fall into this quiet bubble bucket. So I've prepared a chart here for you, and some of the names that I think might be candidates for this sort of quality bubble are Microsoft, the Coca-Cola Company, Apple, Heiko Corporations, Costco 100%, the Sherwin-Williams Company, Home Depot, and S&P Global. And I'm sure there are many more, and I'm happy to hear some of your suggestions, or to read about your suggestions in the comments down below. So feel free to add names to this list. This is not a definitive list, of course. But what this chart here should show is that we are, of course, looking at some quality names. If we are looking at the return on invested capital earned by these businesses over the last 10 years, we can see that many of these names sort of consistently earned returns above 15%. And if you combine these rate of returns, these returns earned on with a decently high reinvestment rate, obviously you're going to end up with great returns. And that is what these businesses delivered over the last 10 years. So let's look at two charts here. This one shows the 10-year price performance of these stocks. Keep in mind, this is not the total return, because this would include distributions to shareholders as well, but only the performance of the underlying stocks. And as you can see, many of these names, maybe except for Coca-Cola, have created great returns for shareholders. So we have Home Depot with a return above 300%. We have Sherwin-Williams with a return approaching 400%. We have S&P Global with a return of almost 500%. Costco, almost 6x investors' money over a 10-year time frame. And then the three best performing stocks here are Heiko, Microsoft, and of course, Apple. And if we look at the compounded rate of return of these businesses over this 10 years, so the 10-year CAGR, as we call it, we can see that many of these businesses did great. Again, with the exception of Coca-Cola, all of these stocks have compounded at a rate of 15% or more. In some cases, much more, like Microsoft, for example, has compounded investors' capital at a rate of almost 25% over 10 years, which is absolutely insane. Now, the question you have to ask yourself, can these businesses deliver a similar performance over the next 10 years? And quite frankly, I have my doubts about that. And of course, this is related to valuation, because in investing, and you have to realize this, valuation is everything. You can buy the best businesses in the world, but still end up with a poor outcome, a poor performance if you overpay for them. So you have to be very careful to buy these businesses at attractive prices. What you can see here is the EBIT multiple, the enterprise value to operating income multiple of these names. And as you can see, many of these names trade at quite high multiples, and arguably deservedly so, because these are clearly quality names, clearly above average businesses. The question you have to ask yourself is, are they maybe trading at too high of a multiple? So many of these names are trading at a multiple of around 30 times their operating income, and some at even higher multiples. And I didn't even include names like Palantir, for example, which is trading at a much higher multiple, because then the whole chart would have been messed up because it's trading at such an elevated price. Obviously, Palantir I don't want to get into this business specifically here, but is in a different stage in its business life cycle compared to the names you can see on screen right now. Nonetheless, I think a free cash flow multiple of around 500 times adjusted for stock-based compensation is too high for almost any business out there. And I'm just going to show you another chart here that shows the EBIT margins over the last 10 years of these businesses, just to prove that many of these businesses are not trading at high multiples just because these businesses are going through a trough year. Maybe their profitability is depressed for a one-off effect or for a one-off reason. No, many of these businesses are producing pretty much the profit margins they have also produced historically. So what I'm showing you on the right-hand side here is the mean EBIT margin over the last 10 years compared to the current EBIT margin of these businesses. And the same is, by the way, true if we look at the valuation of these businesses on a free cash flow basis. So this chart here shows the price to free cash flow multiple these businesses are trading at. And similar to the previous chart, but I didn't point this out yet, the overall tendency of the valuation multiple of these stocks is upward. So on average, this group of stocks is trading at a much higher valuation multiple today than they traded at 10 years ago. And this is true not only on a free cash flow multiple basis, but also on an operating income multiple basis. And just for the sake of providing here a complete picture, I've shown you the free cash flow margins of these businesses as well, which again highlight that we are looking at some quality businesses. Many of these businesses produce great free cash flow margins year in and year out. And then there is one last valuation related chart that I wanted to show you here. This chart here shows the price to earnings to growth ratio of the stocks we discussed so far. And as you can see, many of these stocks are trading at a PEG ratio above 2, some above 3, and some even above 7 in case of Home Depot. So what I was doing so far is I was looking at the business performance, but also the valuation of some handpicked names that I think could be categorized as stocks being part of what I call a quality bubble. What I'm going to do next is maybe a different approach. I looked at 3 different quality indices. So those are usually indices that consist of underlying components that match certain quality criteria. Usually this would include a certain return on invested capital benchmark that they have to match or surpass, or a certain growth rate over an extended time horizon. And the MSCI US Quality Index, for example, is also trading at quite an elevated multiple relative to its own history. So right now we are looking, I think this is a forward multiple, we are looking at a 27 times forward earnings multiple for this index, which is significantly higher than where this index was trading at back in 2013, for example, which was only a multiple of around 14. Or even if you just go back to around 2018, we were trading in a range of around 18 to 20 times forward earnings. And we're now pretty much almost 50% above that. And the same phenomenon can be observed for the Morningstar White Mode Index. Again, we can see that right now this index is trading at a much higher multiple compared to its own history. Here we are only looking at the 5-year history of that index. And finally, and by the way, a big shout out to Iceberg Invest Long Only Equity here, because he provided me these charts for this video. He also pointed out that another quality focused index, the TEMA Monopolies and Oligopolies Index, ticker TOLL, is also right now trading at a trailing price to earnings multiple of 35. He didn't have access to a historical chart. And what I think all of these charts show is that my hunch is probably right. Many of the stocks that are considered quality stocks, the best businesses in the world, are trading at prices that are at least historically quite rich. And what I think this means for investors is that returns going forward are probably not going to be as good as they were over the more recent past, so the last 10, 15 years. Because what I would expect is that we are certainly going to get into an environment at some point over the next 10 years where these quality names will not trade at such a premium to the broader market, which itself is trading at quite a high price in terms of the valuation multiple, than they do right now. And I do get the counter argument. The counter argument that some of you may present now is that many investors underappreciate the long-term growth potential, the durability of superior growth of these businesses that will ultimately justify the current valuations. Businesses will grow into these valuations because they will continue to compound their revenue at a rate of 15% for another 15 years. And this may be true for some businesses, but if these businesses at any point over the next 10 years trade at a multiple that is significantly lower than the current multiple, this will be a big headwind that will be very hard to overcome with revenue or earnings growth. It doesn't mean that you're going to lose money, but maybe you only end up with a single-digit return here, maybe a high single-digit return. But I don't think you can necessarily count on a 15% return over the next 10 years if you pay 35 to 40 or maybe even 50 times EBIT or free cash flow. So my approach in investing is different. I only buy quality stocks at reasonable prices. So ideally, I find quality names, again, some of the best businesses in the world, at a multiple, a free cash flow multiple of around 15, which I admit is very rare to find. And if you want to be even more disciplined and pay less than 15 times free cash flow, maybe less than 15 times earnings, it may be even harder, but that's the philosophy I follow. I want to be extremely patient. That's the mental model that I try to adopt. And if we now reverse sort of the question I asked earlier in the video, which companies fall maybe into this quality bubble bucket, and ask, well, which quality names are maybe quite cheap right now relative to their peers? Some of the names that I was thinking of, which doesn't mean that I'm a buyer of these stocks right here, but I think they are definitely cheaper than some of the stocks I talked about so far in the video. They are Visa, Google, Meta Platforms, LVMH, and maybe even PayPal. No one's talking about PayPal. I used to own PayPal, actually sold it not too long ago, a couple of months ago, maybe 2 months ago, to use the cash from that position for another idea. But I think PayPal, it has quite a run up. So far, I think it's up 66% from its bottom, so it's maybe not as attractively priced as it was in the $60 range. But PayPal was certainly one of the big names, the big tech names that was trading at a cheap multiple. It was trading at around 10 times free cash flow at one point. Okay, I think this was quite a rant, so let me know what you think. Do I have a point here? Do you fundamentally disagree with me here? Which stocks would you add to the quality at a reasonable price bucket? And which one would you also consider quality names, but that are just too richly priced? Take care.